How can you generate tax-free income? I'm Jordan Goodman, America's Money Answers man, and I want to explain what municipal bonds are and look at their pros and cons as a way to help you reduce your taxable income by earning tax-exempt interest. Municipal bonds, also known as Muni bonds, are debts issued by states, cities, and other municipal entities to fund projects. Bond issuance typically works like this. The government body decides to take on debt in the form of a bond, and often taxpayers must vote to approve it. Then financial institutions submit competitive bids to fund the debt, and then once awarded the bond, they sell the bonds to investors to generate the capital required. Investors who buy the bonds are guaranteed a specific interest rate, usually paid twice a year. Bonds are one of the only ways for investors to earn a specific fixed rate of return. The muni bonds then trade in the secondary market, so you can always sell them at the current market price if you need your capital back. Interest earned through municipal bonds is federally tax-free and state tax-free for residents of that state. So if you're a California resident who buys a California municipal bond or bond fund, you avoid both federal and state income taxes on all interest earned from that bond. You can buy individual municipal bonds, but you typically want to buy at least $25,000 per bond to get a good price. If that's too much to invest, you can buy munis through an open-end mutual fund at companies like Vanguard or Fidelity for a minimum of about $1,000. They offer both national funds that own munis from many states and single state funds that only buy bonds from one state, which would be appropriate for residents of that state. Another alternative is closed-end muni bond funds, traded on the stock exchanges that usually trade for around $25 a share. Closed-end funds trade at a discount or premium to their net asset value of their holdings, which can mean you get a better deal. If you buy a muni fund selling at a 10% discount, for example, you're buying $1 worth of bonds for 90 cents, which boosts the yield you earn. Another easy way to buy a municipal bond portfolio is through an exchange-traded fund, known as an ETF, on the stock exchanges. Because municipals pay tax-free interest, the yields are typically about 2 percentage points lower than on taxable bonds, such as corporate bonds. So munis make more sense if you're in a higher tax bracket, typically from 24% up to 37%. The higher your tax bracket, the more tax you're avoiding by buying munis versus taxable corporate bonds.